Welcome to Wealth Chapters, where we dig into the biggest ideas from the world's best investing books. Today, we're jumping into a really important chapter from The Intelligent Investor. It's all about a number you see everywhere, per share earnings, and it asks a pretty bold question.
So let's just get right to it. There's this one number that gets plastered all over the news, in every analyst report, and it's supposed to tell you, in a nutshell, how healthy a company is. But what if that number, that one simple trusted figure, isn't telling you the whole truth? What if it's actually hiding the real story?
So our investigation begins with that one headline-grabbing figure, per share earnings. You've probably seen it called EPS.
So what is it exactly? Well, on paper, it's pretty simple. You take a company's total profit and divide it by all of its shares out there in the market. The idea is to show you how much profit there is for each share. And it seems obvious, right? The higher the EPS, the better the company's doing. But is that really all there is to it?
I mean, imagine you're looking at a stock and you see this, an EPS of $5.72. Wow, that looks really solid, doesn't it? It feels like a big green light, a signal that this company is a winner and you should get on board. And that's exactly why Wall Street absolutely loves it. It's so simple, it's easy to compare, and when that EPS number goes up, the stock price often follows right behind it. But as the great Benjamin Graham teaches us, the intelligent investor knows that the easy answer is almost never the full story. You gotta dig deeper.
Okay, so let's put on our detective hats for a minute. This is where we start to find the first clues that this number can be, well, a little bit deceptive, thanks to some clever accounting tricks and these things called one-off events.
Just take a look at this. On the left, you've got what you see on the surface. High earnings, consistent profits, it all looks fantastic. But the reality, over on the right, can be a totally different picture. Those super high earnings, they could be getting a huge one-time boost from something like selling off a headquarters building. That's not going to happen again next year. And that consistent profit, well, it might just be some fancy accounting footwork that's smoothing out the bumps.
And this really gets to the core of what Graham was trying to tell us. He's basically warning us not to get seduced by these amazing-looking numbers during the good times. An intelligent investor doesn't just take the company's word for it. You have to dig in and figure out if that success is the real deal, or if it's just a mirage that's going to vanish when things get a little tough.
And this idea leads us perfectly to our next point. You absolutely have to take the long-term view. A single year of earnings is just one snapshot in time. It's not the whole movie.
Check out this chart. In year 2, the company reports this monster EPS of $6. Now, if you didn't know any better, you might see that and dive right in, thinking the company's growth is going through the roof. But look at the years around it. The truth is, the business is kind of flat. That giant spike? It was just a one-time sale of an asset. The real underlying business didn't magically get better. See, context is everything.
So the crucial takeaway here is this. Looking at a company's earnings over 5, 7, maybe even 10 years gives you a much more honest picture of its health than any single year ever could. The trend is always more powerful than the snapshot.
But it's not just accounting tricks you need to watch out for. There's another, more subtle way to make the EPS number look good. We're going to call it capital structure shenanigans, and it's a way for the number to go up without the business earning a single penny more.
Let's just walk through this. It's pretty wild. So, step 1. A company makes $100 in profit, and it has 100 shares out there. Simple math, right? That's an EPS of $1. But then, in step 2, the company uses its cash to buy back 10 of its own shares. Now look at step 3. The profit is still exactly the same, $100. But now there are only 90 shares to divide it by. So what happens? Boom. Step 4. The new EPS is $1.11. That's an 11% increase created out of thin air. And this is the part you really have to get. Nothing about the actual business improved. It didn't innovate, it didn't sell more stuff, it didn't get more efficient. All it did was change the denominator in the math equation. Now, share buybacks aren't always a bad thing, but you, as an intelligent investor, have to know when EPS growth is real versus when it's just financial engineering. So, with all this going on, how do you actually protect yourself? Well, it really all boils down to adopting the right mindset. You have to stop being just a passive consumer of financial news and start becoming an intelligent investigator. So here's your new toolkit. First, always question those big headline numbers. Second, always demand context. Zoom out and look at the long-term trends. Third, get comfortable with the idea that accounting isn't always black and white. It can be used to paint a pretty picture.
Fourth, keep an eye out for things like share buybacks. And most important of all, always bring it back to the real question. Is the actual business, the thing that makes the money, getting better?
So, the next time you see some flashy EPS number, just remember this. Those numbers aren't the final answer. They're just the first clue in a much bigger mystery. And your job, as an intelligent investor, is to use those clues to find out what the real story is. So what story are your investments telling you?